Right, my clock says 11 o'clock, so I guess we'll start now. Good morning, everyone. My name is Les Pick. I am Director of Intermediary Sales here at LiveMore, and today, thank goodness, I'm joined by Matt Evans, who's our head of underwriting, who's going to talk us through the underwriting proposition that we have here within the business. So thank you very much for joining us this morning, and for taking the interest in our product proposition and range. Today we're going to cover over a few ways that advisors work with us, and hopefully you will find it interesting and informative, because we know you don't use us necessarily every single day of the week. So it's important to keep us front of mind and let you know what it is we do and how it is that we work. And in that in mind, we are keeping you in the know. So hopefully, if you haven't been on one of these before, you'll find it very informative and interesting. One of the things that we do find when advisors use us, this is something that is new to me since I joined LiveMore a few months ago, is that advisors tell us they were the third or fourth advisor that a particular customer had come across or had to use in order to find us. So hopefully if you've attended this webinar, that won't be a thing for you anymore. And of course, what that means is you'll be the advisor that they see first of all, and hopefully the one that then earns the money off the back of it, because ultimately that's what we're here for, helping consumers and earning a living. In terms of what we're going to cover, we've got big changes to later life lending that have taken place in the last sort of 6 to 12 months. How you can support your clients over 50, effectively saying yes more often and therefore being able to place more cases. We'll talk through our affordability, our products and our properties. So that's the underwriting bit. And then we'll look at a few case studies just to see how advisors actually use us. And the case studies, by the way, are real case studies. So these are exactly how advisors have used us in the past. So changes to the later life lending sector. I think it's fairly well reported now that we have obviously had Consumer Duty come through last year. To most financial advisors doing a good job, I don't think there was very much to change. Many advisors that I speak to say, look, Consumer Duty, it was something of nothing for us. Yes, we've got to document what we do. But in terms of how we interact with our clients, nothing really has changed. We were looking after them well before. We were clear in how we worked with them, and we had solid relationships. Nothing has really changed except for the fact I now need to document how I'm working with my customers and how I'm proving fair value. The 2023 FCA report towards the back end of last year gave the later life lending world, in inverted brackets, a bit of a kicking. But what I will say is it was looking specifically at equity release, and it was looking at the larger equity release advice firms. They were disappointed in some of the later life outcomes. That said, I think there's an awful lot of good done in the later life lending sector and in equity release world as well. Many advisors doing a phenomenal job out there. One of the things that I hear advisors saying is they're saying, well, look, they don't want advice offered in silos anymore. Therefore, we all need to give advice on all of these products. I don't think that's the case. What they're saying is that if you are only going to write 20 equity releases a year because that's what you want to write, that's absolutely fine. Or if you want to write 20 Rios a year, that's absolutely fine. If you want to be specialist, there's nothing wrong with that. But what you now need to do is document your client interactions rather than your new business log. So this is something that I've been driving around the country over the last few months trying to explain to advisors. It's really, really important that if you want to be specialist, you can remain specialist, but you just need to have that knowledge and understanding of where to refer to other types of products. So long as your customers get the right product delivered in the right way, then the FCA aren't concerned how they necessarily get it. So if you want to be specialist, you can remain specialist, but what you do need to do is have a really robust and thorough triage process, so a fact-find process that identifies where a client might need interest served rather than equity release, or might want equity release instead of interest served. So just about getting the right products to the right people at the right time. And I think with all of the complexities that have come into the later life lending space, now more than ever, an affordability assessment is not just undertaken but also fully logged. And so that's the main thing. If you're going to have 100 client interactions a year and just sell 20 of a particular type of product, make sure that you log the 80 customers, what happened to the other 80 customers that you interacted with? So maybe it wasn't the right time for them to do something and you were told them to put what their plans on pause. Maybe you referred them to a different type of financial advisor who had specialist knowledge in a particular subject, and then maybe you dealt with whatever was left, and that's fine. So the important thing is to protect yourselves, document all of your client interactions, continue to do the great job that you were doing before, and make sure that affordability assessments and also health assessments, not that that's our world, but also health assessments, those health questions are also undertaken, because that can make a significant difference in later life lending world, particularly in equity release. So in terms of the opportunity, so you guys have come on the webinar this morning to learn a little bit more about later life lending. If you're in equity release world, we need to understand that the sector might be worth circa 3 billion this year. The annual over 50 market in terms of mortgages is absolutely huge. It dwarfs equity release world, 10 times bigger. And of course, we've got the 50 plus market, including the back book, 130 billion. And we've got UK housing wealth with the over 50s at 2.8 trillion. So in equity release terms, we're barely scratching the surface of what could actually be actually used. But what we also have, as we know, until 2032 is that big, huge swathe of interest-only mortgages that are coming to an end, where customers are looking for solutions and maybe an extension to that interest-only problem that they've got. 200 billion of interest-only mortgages are expiring over the next 10 years. It's absolutely huge. The size of the opportunity is massive, and I'm guessing that's why so many people are engaging with the later life lending sector if they haven't done in the past. The banker family is growing. We don't say banker mum and dad anymore. We know that aunts, uncles, nans, granddads, all forms of family and friends, family friends as well, are continuing to lend to first-time buyers to help them onto the ladder for the first time, give them that early inheritance. We have to remember that if people are going to live, if you've got a couple in their 70s, there's a very, very good chance one of those is going to make it into their 90s. That makes their children in their 60s and their grandchildren potentially into their mid-30s, even into their 40s. So we have to understand that if we're all living longer, that wealth that we're holding on to will be held on to for longer. So later life is basically becoming mainstream. I am now 51, almost 52. So I find myself in LiveMore lending territory. I'm already in later life lending world, horrific as that sounds. So the reality is later life isn't really later life. I like to think of it being midlife. So it's midlife and beyond. And I think that's really the issue. And I think the issue that financial advisors have is it's easy to kick the can down the road by giving somebody another 2-year fix or another 5-year fixed. But I really think that if you want to serve your customers to the best of your ability, what we need to be doing is looking at solutions and strategies and creating a strategy for your customers so that we say, okay, if you're 50 or you're 55 or whatever, you've got a mortgage of X. If that's going to go above and beyond your normal retirement age, and of course, normal is what somebody wants to retire at now rather than a given retirement age of 67, 68. So if it goes beyond your 70th birthday, when you plan to retire, what is it that you're going to do? How much do you think your house is going to be worth then? What will your pensions be worth then? Are you likely to receive any inheritances? Will you actually want to downsize or not? Are these real, have those deeper conversations, interrogate your customers, and don't just take another 2-year fix or 5-year fix and kick the can down the line. Actually deal with the problem. And of course, if you're dealing with the problem, it might be that you're a mortgage broker and your knowledge of pensions is very, very high level. If that's the case, work with a wealth manager, work with an equity release specialist if you don't do equity release, work with a mortgage broker if you just do equity release and you're not interested in doing RIOs and TOs. Work collectively as a group. In the same way as if you were in hospital, various different consultants and surgeons would work together in order to fix you. I think that professionals in financial services need to do exactly the same thing. And it is a new era for later life lending because it has become so much more complex with so many more solutions offered by so many more lenders. Our CEO says we're firmly of the belief that affordability assessments should be undertaken in all cases. And I think I know that we've got, so looking at the people that are registered for this, I know we've got some equity release specialists on here who I know that in all cases will always carry out an estate benefits analysis. And I think it needs to be now that built into your process, this side of Consumer Duty, and with the products that are available right now, medical questions should always be undertaken in all circumstances. Some of you will be saying, well, we do that. Yes, you do, but not all people, not all advisors do. Affordability assessments should be done in all cases, and that's quite clear from the FCA's steer that they gave us at the end of 2023. And then, of course, as well as the medical and the affordability, I think we just need to be making sure that we're also looking to ask those wealth questions as well. So in terms of the right route, as the FCA would see it and Consumer Duty would see it, if you've got somebody with a problem that needs a solution, we should be looking at mainstream mortgages first, where we can potentially get the most flexibility and the best value. Then we'll be moving on, so that's the TOs and C&I. So term interest only and capital and interest, followed by RIOs, followed by finally equity release. So all of the options need to be considered, and not just considered. If you want to protect your business, it needs to be documented as well. And that's why I think we need to, as a sector, come up with as many tools as we can as lenders to be able to help and guide financial advisors through a more complex advice world. And with that in mind, we are the only lender that offers 4 different types of mortgage. So we have a capital interest, we have interest only, we have retirement interest only, and we have equity release. Many customers that come to us, financial advisors that come to us, will come in on one particular product range and find themselves on a different product range by the time they've been through the calculator and actually been through the application process. We're really lucky here to be able to offer all forms of lending. But of course, again, it only goes to reiterate exactly how complex later life or midlife lending can be. Just for your attention and note here, obviously we've got various different products, and we've got some notes here on how they work. Basically, our equity release plan is 55 plus, in line with other plans, but retirement interest only, our interest only, and our capital and interest all start at 50, which is why I say I'm actually able to now obtain a mortgage from a later life lender. So a few notes there, really, just to go through on the interest served, a couple of highlights. Affordability assessed on interest payments at all life stages, on the retirement interest only. Just to bear in mind, of course, on a RIO mortgage, that is for life, just like a lifetime mortgage. And of course, redemption is on death or if somebody goes into long-term care. So just like an equity release scheme. So we've got equity release and RIO for the later life customers that don't want a fixed term. We've got interest only, capital and interest only for those that want to serve the interest and want their mortgage over a specific term. We're really lucky to be able to offer all 4 options. And how do we get to those options? Well, we have arguably the most sophisticated affordability calculator in the later life lending world. So by all means, go to your sourcing systems. You might find that we're not necessarily there. We don't necessarily play the rate game. So there are lenders out there offering lower interest rates, but where we fit is the underwriting. We say yes more often to more properties, more types of income, and that's where Matt's expertise will come in just a minute. But if you look at here on the left-hand side, we've got the retirement interest only, capital interest, standard interest only, and a lifetime mortgage calculation. So this is somebody using our calculator, popping the details in from the fact find and coming up with various different solutions. It's important to note that when financial advisors use our calculator, roughly 40 to 50% of the time, depending on the month, financial advisors will change their advice and change their product set based on the outputs of the calculation. So the calculator is so powerful that it's actually informing advisors' decisions. And I think I want to point out here that if we are going to make affordability checks part of every single case that you do, obviously you'll do that in mortgage world. Yeah, we get that. But in equity release world, this is something that's relatively new, and it's a new requirement for equity release specialist advisors to do. It's important to note that you can, of course, put your customer details into the system. You can produce the report. You can then print that, or you can save it and email it, whatever, depending on how you're interacting with your customer. But the really important thing is that you leave these details on the file so that should the SCA come knocking in a year or two's time, or 10 years' time even, you will be able to document and identify and prove that you have taken your customers through an affordability calculator. LiveMore are very lucky to be in the position of offering some of the highest income multiples in the country, if not the highest, depending on a customer's situation. So if you've taken them through this process, it proves that you've had the conversation. It gives you effectively an agenda to speak to your customer about, to say, look, it's really, really important. I know that you want a lifetime mortgage. I know that you don't want to pay the interest, but I have to take you through this process. I need to show you that in your particular circumstances, it's given an approximation, it's possible for you to, on a RIO, on a standard capital interest, or on a standard interest only mortgage, get this kind of figure at these kind of rates. So it's really, really important to have that discussion with your customer. And we know that many equity release specialist firms are now using our calculator as standard in 100% of their cases. So it's become part of their compliance process. So I think the key highlights are, it's great that we're able to offer all 4 different types of product here at LiveMore. It's great that we have super high income multiples, which are really helpful to customers. And it's great that we've got an all singing, all dancing, very complex, well, see, at least complex from a behind the scenes side of things, simple for you to use calculator. So that calculator will give you the evidence that you need to prove that A, you've had the conversation with the customer, and B, give you that agenda to have with the customer so that you can identify whether interest served may or may not have been an option for them. So in short, here at LiveMore, we try to say yes more often. We've got more affordability. We'd like to say yes to more properties. And of course, we've got the only lender with all 4 product sets, so we have more products. I suppose ultimately, from an ex-advisor's point of view, what we help you to do is say yes more often. Nobody wants to be the financial advisor that walked away from a client or a case because they didn't necessarily understand or know about a particular product set out there. I actually had a conversation on LinkedIn this weekend with an advisor who'd given us another case. I know the advisor, so I popped him a little message to say thank you very much for the case. He said, no problem at all, always happy to support LiveMore. He said, more advisors. The only problem is more advisors need to know about what you do. So thank you for attending this webinar today. That's a load more advisors hopefully out there who will know that even if we don't necessarily show on your sourcing, come out of the sourcing, come to the calculator, see what it is that we can do and how we can help you to say yes more often to more customers. And with that in mind, I'm going to hand you over to Matt now, who will talk you very skillfully through our underwriting criteria. Over to you, Matt.
Thanks, Les, and morning, everybody. Thank you all very much for giving up your time this morning. It's a real pleasure to be able to speak to you all. So I'll touch on a few slides in relation to how we look at income, property, and a couple of case studies as well. So we'll start off with income. As Les has alluded to, we manually assess and underwrite all applications. What this really provides us an opportunity to do from an underwriting perspective is really understand the specific circumstances of each case. Les has done a really good job of providing the opportunity in relation to the market and the different product types that we offer. And we are aware that every single different application does have different parameters. He touched on, for example, retirement age. We're completely aware that people are no longer retiring at a traditional retirement age, whether that be triggered by state pension. So, for example, that then enables us to use a salaried income up to a higher age. So, for example, up to 75 and in excess of that in some cases. That's very much down to the actual specifics, but it's just a really good example of how that then translates in real life terms of how we're underwriting those applications. We don't just have a blanket rule of, okay, it's 70, so it's the only income stream that we're able to look at that age. We're able to look beyond that. We're able to look at the overall profile, and we're able to look at different income streams at different times throughout an application. The retirement is always subject to a plausibility check. Of course it is, but because we're able to manually assess and look at the whole profile, it more often than not we're able to find then a solution for that case based on the scenario. Same goes for self-employed. So, for example, we're aware that if you've got somebody who is a director of a limited company, that dividend and income stream that they receive from that business isn't just going to stop at a normal or traditional retirement age. So we can look to then take that income in excess of 75 in some circumstances if we get comfort that the business is able to support that. We're also aware that more and more people are renting rooms out. For example, the property is still a traditional residential property, but they rent a room out for a lodger, and we're able to evidence that income that we can take that into consideration as well. I guess as well, what one point to touch on in relation to incomes is that we're not limited in relation to how many different income streams we can use. So here are we've given an example here of the most common income types that we see on applications, and more often than not, we are utilizing several different income streams throughout an application. Commonly where an applicant is employed at the start of the loan term, then moves into a post-employed income stream, so whether that be a pension or utilizing a different asset set. So we can utilize different income streams at different times throughout the application. And as I said, we're not limited to how many different income streams we can use per application. And because we do have that sophisticated affordability model built into our platforms, it's really super easy for when you're submitting an application to input that information, and then we can then underwrite it when we get the applications received. So if we move on to the next slide, we'll thank you. So as I said, in addition to the incomes and all different types of incomes we can use, we can also consider other such assets. So, for example, we can look at an applicant's overall profile, and this really does fit to what I was speaking to before about the fact that we're not just looking at what the situation is now. We're looking at the situation over the holistically over the term of the loan, and the overall profile for that applicant and application. So we're aware that applicants within our demographic may be income poor but asset rich, for example. So they might have investments, whether that be cash or other financial investments that we can then utilize to support the affordability for an application. We can also then, in certain circumstances, also use equity from assets to support affordability at weaker stages. So that really can be utilized when income streams at retirement may be lower than what they are at pre-retirement, and then we can then assess what assets the applicant has and then utilize that to then bridge the gap in relation to that weaker stage of affordability when income streams, as I said, post-employment rather, are not necessarily as high as they were pre-employment. But this really just gives you a really good indication and a good idea of what we're also looking at beyond just traditional income streams. Yes, we have a whole wide income streams available, as I touched on the slide before. But in addition to that, we can also then utilize other assets and other investments that customers have, even if at the time of underwrite they're not drawing on those assets, they are still building those investments. We can then utilize them in the affordability calculation when they plan to start utilizing that. And the same goes for any sick pensions, for example, that the customers actually looking to then build. They may not be retired yet. That's absolutely fine. We can consider ongoing contributions, which will build that pension pot. So when they do then start drawing on those assets, the affordability isn't essentially compromised. So we can make sure we can achieve those maximum loans that the customers are looking for.
I think just to add to that, from an advisor point of view, if your knowledge of SIPs and SASs and various different types of pension isn't right up there, that's why we say work together with a wealth manager to create that solution and create that strategy, so that you don't have to necessarily understand the workings of it, but need to understand when to pull somebody in to support.
Thanks, Les. Yeah, so as touched on before, in addition to our affordability criteria, we're also really flexible in relation to the type of properties that we can lend on. So here's a list of common properties that we encounter and underwrite on a daily basis. We use Connells for our panelled surveying company. We've got a really good relationship with Connells. They really understand LiveMore and the risk appetite that we've got in relation to property underwriting. So the underwriters themselves will liaise directly with surveyors. If it is a more, I guess, complex, but don't really want to use the word complex, but from our perspective, lending near a commercial property, for example, isn't complex, but we want to make sure that the surveyors are aware that there's certain aspects of the security that we're happy with. And as I said, in relation to the close proximity or even above commercial, what we're really looking for and what the surveyors are really looking for is how impactful is the location of the property from like a social disturbance perspective. So they're the sorts of things that we're looking at underwriting stage. I also completely am aware that these sorts of instances, when you're coming to kind of proximity to commercial, for example, are very much kind of subject specific. So if you do have a property that you're ever not sure about, please speak to your national account manager, who in turn will speak to the underwriting team, and we can then do some pre-checks before the application is submitted to make sure that we're happy to progress with the application. But we lend on these properties on a daily basis. It's a real key aspect of what we do at LiveMore. And as I said, the way that we underwrite the applications and liaise and work with our surveying company really does give us that benefit to be able to then not just say we're going to do it, but as Les said at the start of the call, actually then get an outcome, get an offer, and complete on these cases. We're not just going to say we do it and then decline at evaluation stage, because we are able to do that pre-work, pre-application if needs be. Some lenders don't like properties with annexes, outbuildings. Again, not problematic with us. We have some different rules in relation to the different product offerings. So, for example, on our equity release product, the outbuildings can't be used for commercial use, for example. But again, on our standard mortgage products, we commonly see applications with outbuildings. They can be rented out. They can be used for family use. They can have different utilities, different council tax bills. Again, that's not problematic as long as they're within the same title. So that's something commonly used. And yeah, close proximity to rail lines in the same way as close proximity to commercial. It's not just the case of in the same way of the example I gave with the income. We're not just a lender that will look at something and go, okay, it's in close proximity to something that could potentially be impactful. We will actually look at the specifics. We will look at the properties that have sold from a comparable perspective. We will actually do the legwork from an underwriting perspective because we want to make it work. We want to make sure that we can achieve these outcomes. So all of these different property types, as I said, we're used to underwriting on these properties. We come across them on a daily basis, and we want to work with you from an underwriting perspective to understand the nuances of it so that we can find these outcomes.
Thanks, Matt. And then just a couple of things that I know advisors have come to me about. So there's in terms of property types, we are the only equity release lender that will look at spray foam, but you do need to get that spray foam removed and the damage repaired if there's any damage. The other one as well is we accept a ground rent above £250, which most equity release lenders, not all equity release lenders, won't take. So if you've got a ground rent at £300, for example, and the overall service charge is within our parameters, then if you've got that issue, do pick up the phone to us. So it won't necessarily show on your sourcing as that, but we will look at it. Matt, we've got a couple of questions, if that's okay. I know the answer to one. So Ian has asked if we lend in Northern Ireland, and the answer to that is no, unfortunately we don't. I believe it's just I think that will lend in Northern Ireland, whether Aviva I think also might, but no, not us at this time. And then concrete properties, Matt, can you give some clarity on concrete properties, please?
Yeah, absolutely. So essentially, it depends on what sort of product that we're looking at. So from an equity release perspective, we're fairly limited in relation to concrete. But on our standard products, we can accept like wimpy no fines, easy allowing easy form, panel, poured concrete. So from on our standard product, it may depending on the type of concrete. It may have an LTV restriction, for example. Depending on the actual type of concrete it is rather, just please refer that to us, and then we can then come back to you with exactly what we can offer on what different product set, because it does differ. Essentially, we lend on properties with concrete. As I said, it will just differ slightly in relation to different LTV restrictions depending on what product we're looking at in accordance with what type of concrete it is, but it's something we lend on, yes.
Thank you, Matt. That's awesome. Let's see if we can get it. Screen is now frozen. There you go.
Excellent. Thanks, Les. Yeah, so in addition to the affordability and property, we also manually assess credit profiles. What that really gives us an opportunity to do is to easily identify where there's been life events that aren't in keeping with credit profiles. So we can proceed with applications that have had missed payments, whether that be on a mortgage, unsecured missed payments, or even debt management plans. And we've recently amended our product range, and we're really excited to do to introduce the debt consolidation plan, where we can lend up to 100% debt consolidation. We then also can then lend if there has also been missed payments when we're lending for someone with debt consolidation. I know some lenders have a different stance in relation to that. We look at it quite differently. We're aware that lending for debt consolidation is something from an advice perspective that needs to be taken very seriously, and there's some complexity when it comes to that. However, we want to make sure that we've got a product available that actually fits the actual demographic for that type of borrower. We're aware that interest rates on revolving credit can be really high. We're therefore very aware that in the current climate, that can really then impact from a minimum payment on a credit card with a really high APR, for example, that keeps going up and up and up. We want to make sure that we can have a product that suits and fits within that, even if, for example, a customer has missed a payment because of the continuing increase in relation to the payments from the revolving credit. So we're really excited to add the debt consolidation product to our product offering. And as I said, then the underwriters can then really get a good understanding from when they're working with you, reviewing the credit profiles, and if we have any questions in relation to any missed payments that, as I said, maybe linked to life events, we can ensure that that's then taken into consideration when we're reviewing the credit profiles. And here, I really like this slide. It's a really good example of the sort of cases that my team are assessing on a day-to-day basis. Les has touched on some of these earlier, so I won't go into the specifics of every single one. But for example, just touch on debt consolidation. We see a lot of customers that are at the end of term with their initial interest-only mortgage at the moment. And to Les's point earlier, a lot of these customers, from when we speak to them, they're just not aware, or there's a common misconception that due to their age and due to the fact that they have an interest-only mortgage that is either expired or expiring soon, they're not aware that there is another option, whether it be equity release, whether it be a retirement interest-only mortgage, or whether it be another standard interest-only mortgage that suits within their circumstances. They're not aware of that, but they're common cases that we see on a daily basis, along with home improvements. Again, bit of a misconception that if we are lending to somebody who is at the end of their interest-only term, it doesn't mean that that's the only thing we can lend to them. They might also then think, okay, we want to make some alterations to the property. So we do a lot of mixed multi-use purpose as well. So there can be a mix of several different things within an application, including whether that be debt consolidation, some home improvements mixed in with the remortgaging from an interest-only mortgage that is soon to be coming to the end of its term. Linked in with the fact of, because we do manually assess each different profile, we're able to then really work with you to find the solution that fits within the client's needs. And finally for me, it's got a couple of real life and really interesting case studies for cases that we've seen. Example here speaks to the affordability that we've spoken about today. Had an applicant that other lenders wouldn't consider from an affordability perspective because it wasn't deemed as like a traditional income stream. For example, in this instance, the customer just drew from the business what they needed to. We were able to then look past that. We're able to assess the overall profile and get comfortable with the fact that we could consider the retained profits towards the affordability. And in this instance, then we were able to then offer the customer the maximum loan that they needed, which in this instance was £1 million loan, and that was on a 10-year fixed product. But it really is a really good example and a real life example of how we've then looked beyond the traditional income sources, beyond the traditional income streams, and actually looked at the applicant, because that's what this is all about. It's something we firmly firmly believe in here at LiveMore. We want to work with you to find solutions, but we want to look at the applicant. We want to look at the applicant scenario and the specifics of that scenario to then find the outcome that that applicant deserves. And I think personally, this instance is a really good example of that. That you've got someone who can clearly afford it. Yeah, the income streams aren't what a high street lender wouldn't class as traditional, but we're keen to always look past that and beyond that where we need to. And this is a really good example of that.
That's a good one.
And then the next one is a property example. So touching on what I alluded to earlier in relation to our desire and willingness to lend above or close to commercial. Had a property that was turned down by another lender because it was in close proximity to a village pub. And there was no impact from a social disturbance perspective. It was a mixed residential with some commercial area. There've been local and recent sales in the property that were comparable to our property. It was a property that's suitable for mortgage purposes, and just because it's located in close proximity to a pub, again, in the similar instance to that I gave an example to in the slide before, we're able to look past that. We don't just have that black and white mentality of the fact of, oh, it's near commercial, we don't want to do it. We're able to then look at the specifics, touching on the details that I've alluded to before around the fact of truly understanding the scenario and truly understanding then the need and what we need to then work with our surveying company. And this is a really good example of something that, again, we've been able to find that solution by not taking the easy way out and going down a generic route of the fact that it's near commercial. We want to look into the details, and again, really good example here of how we've been able to then find that solution.
Yeah, that's another good one. And the point is here, this is a financial advisor that's been able to say yes that otherwise would have been a no. That's a consumer helped out, and that's also somebody earning a living. So it's good news for us, but it's also good news for the other parties involved in it.
Excellent, thanks, Les. And finally for me, before just kind of introducing you to my team briefly, from an underwriting perspective, I guess more and more now you hear about lenders and direct access to underwriting. So just to give you a little bit of a flavour of what that means at LiveMore, because I really do feel that we live it and we really enjoy it. The underwriting team will be proactive in relation to working with you, as I've touched on, quite a few times already in the presentation this morning. We're really keen to get a really good understanding of that application and of the application specifics. If it's a straightforward application that comes in, we're not then going to bombard you with phone calls and emails. We've got a really new and improved case tracking system where you can easily go into the portal and see where an application is. But where our underwriters really come into their own is for those more, on the face of it, complex applications, or complex scenarios, but for us are straightforward. We see them on a day-to-day basis, and the team will want to proactively work with you to get an understanding of what that specific scenario is, that therefore then can lend to finding a solution for that. And as I said, that will be proactive. We want the relationship to be balanced. It's something that I really try to strongly believe in. We want to work with you. We're definitely not here to work against you. The team have all got a lot of experience working within specialist lending, and it's something they really enjoy working with our broker partners to make sure that we can take the specific scenarios of the applications we're seeing, do our work, and then make sure that then we can find solutions for these customers who are deserving of it. So we're always on hand when needed, and yeah, those on the call that we've already worked with, and those that we haven't, look forward to working with you in the future.
Thanks, Matt. It's brilliantly put.
And this is just the team. As I said, relatively small team, really vastly experienced, as I said, in relation to specialist lending. If you do have any queries at all, our emails there from an underwriting perspective. As I said before, as Les alluded to, your national account managers are your first point of call. They liaise directly with us as an underwriting function, that we can then deal with any kind of pre-application queries or submission queries or anything that you've got. But the team will always be available when needed, for when the application is submitted, along with, as I said, the case tracking, which is a really useful tool that we've got on the broker portal. You can see where an application is at any time.
Lovely. So thanks for that, Matt. I mean, hopefully, from a financial advisor point of view, you can see that we have that kind of open approach. Of course, you've got your BDMs that look after you, the telephone account managers as well. So if you can't get hold of your business development manager, get hold of your telephone account manager. If you can't get hold of them, get hold of me. Somebody will be there to look after you. And of course, Matt's team are as well. And ever since I came here, for those of you that know me on the call will know that I was a financial advisor for 15 years or so, 17 years, in fact, I think in the end. You know, I can see that can-do attitude from the underwriting team, and certainly that's, you know, the feedback that I also get from the brokers that I speak to. One of the things I'll say is that we don't say yes to everything. We can't say yes to everything, and actually Matt's team would probably like to say yes to more than we can say yes to. But in reality, it is being that smaller lender, we are able to look on a case-by-case basis. Matt, there's a couple of questions in. Are you happy to sort of answer a couple of questions?
Yeah, absolutely. Yeah, I can see. So there's a question in relation to properties with two kitchens. We can consider them. It very much depends on the actual specifics. So, for example, I guess like with most things that we consider from a property perspective, as long as the actual core elements of the property are set up as a traditional residential dwelling, where we can't lend is in scenarios where essentially they've been set up as more of like a, not necessarily a HMO, but they've been split into two properties, and they've got a kitchen on, you know, the first floor, along with completely separate living arrangements than the ground floor, for example. You know, we're looking at, would any alterations need to be made to that property to then essentially kind of market it in the future as a traditional residential property. So we've lent on properties with two kitchens before. It really does depend on the actual specifics of the setup and layout of the property. So if you do have an example, I think it's Jeremy, thanks very much for the question. If you've got a specific property in mind, please send it over to us. We're more than happy to have a look at it and take it away, because it really just depends on the actual specifics. But it is definitely something we can consider dependent on the actual circumstances. I've seen another question in relation to do we consider retirement properties on equity release? We don't at the moment. We can consider retirement properties on our term interest only, or on our standard mortgage products. It really does depend, though, on what type of retirement property it is. Where we struggle, and this is just purely down to getting a value on the property, because unfortunately there isn't more mortgage companies that do consider these types of properties, are things like the retirement complexes and villages. So we do struggle with those sort of cases at the moment to actually get them valued. That's not from a willingness from our perspective. As I said, that's more of the wider market, but we can consider things like age restricted properties on a case by case basis, but that is not on the equity release product side of things at the moment.
Right. And I think there was just one on waivers of Alan's put one on there. What about waivers of occupation?
So yeah, we if there's adults in the property over the age of 17, then we do require a waiver form to be signed, and that's standard across all of our product offerings.
Excellent. Thank you very much. Well, I think that's all of the questions answered. So I think that really concludes the webinar today. So thank you, Matt, for coming on. To everybody that attended the webinar this morning, we have really good numbers. So thank you ever so much for spending 45 minutes with us today. I hope you found it useful and informative. Please try and retain the information as best you can. Or next time you're saying no to a customer, maybe just at least remember to come and have a conversation with somebody at LiveMore first before you let them walk out the door, and that customer becomes the customer that has to go to 3 or 4 mortgage brokers before they get the answer that they wanted, which was of course a yes, to help them with whatever problem that they've got that they need a solution for. So thank you ever so much for coming on today, and we'll look forward to seeing you and speaking to you soon. Take care.
Thanks, Les. Thanks, everybody.